Forget investment banking. Forget private equity. Forget hedge funds. If you're a finance bro who thinks Excel is a love language, wears Allbirds unironically, and dreams of sipping Oatly lattes while funding the next billion-dollar idea, there's only one place you belong: venture capital. It's like private equity, but with hoodies, AI pitches, and a God complex. It's the only part of finance where having a Substack makes you more valuable than having a CFA, where being early matters more than being right, and where saying we believe in founders can get you a board seat and a 20% carry. But what even is VC? What do these Patagonia-wearing PowerPoint wizards actually do all day? And why does every partner meeting feel like a live TED Talk moderated by someone named Connor? Let's decode the cult. Venture capital is basically betting on nerds before they get cool. It's giving money to startups before they're profitable, scalable, or sometimes even legal. You're not investing in balance sheets, you're investing in potential, in conviction, in vibes. In a pitch deck with just the right amount of pastel gradients, it's high risk, high reward, like crypto in 2021, but with more coffee and fewer lawsuits. You invest early. You get equity. You pray for an exit. And you tweet about power laws to hide the pain of the 8 failed seed bets last quarter. If it works, congrats, you backed the next stripe. And you'll definitely remind people of that for the next 10 years. If it flops, you go on a podcast and say, we didn't lose, we learned. That's the game. VC is ruled by the power law. One unicorn makes up for 19 dumpster fires. Seriously, 90% of your portfolio can implode. As long as one company exits with $1 billion valuation, you look like a genius. Just ask your friendly neighborhood VC. Yeah, bro, 95% of our startups are dead, but that one exit, legendary. Translation: I now own 3 Teslas and a Peloton I don't use. All right. Here's the money flow. Ready? There are 3 types of players in this game. Let's keep it simple. First, the LPs, limited partners. These are the big money folks. Pension funds, university endowments, sovereign wealth funds, family offices. In other words, people with way too much money and not enough time to spend it. They want exposure to startups, but they don't want to talk to 520-year-olds pitching GPT-powered dog walking apps. So they hand their money to... Second, the GPs, general partners. These are the actual VCs. The ones managing the fund, sourcing deals, signing term sheets, and tweeting philosophical takes about founder resilience. They build a portfolio, aim for outsized returns, and take credit for every win, even if they only met the founder twice. Third, the startups. You know them. 2 sleep-deprived co-founders, 19 open Chrome tabs, and an unrealistic revenue projection made in Figma. Startups are the heart of VC. They raise cash in exchange for equity. They burn that cash trying to grow fast enough to survive. And sometimes, just sometimes, they change the world. But more often, they pivot so hard you forget what their original idea even was. The cycle works like this. A GP raises, say, 100 million from LPs. They plan to deploy that capital across 20 to 30 startups over 3-5 years. Each check ranges from 500K to 5 million, depending on the stage and hype level. If one of those bets becomes a unicorn, they're golden. If not, well, at least they can write a thought piece about market timing. And the kicker? VCs charge 2% of the total fund value every year just for existing. So with 100 million under management, that's 2 million annually for running the fund, plus 20% of the upside if things go well. Imagine being paid millions to say, we're excited about the team and still have people thank you. Venture capital, the only industry where you can lose money and still end up on a Forbes list. So what do VCs actually do all day? Let's break it down because, spoiler alert, it's not just sipping cold brew and nodding at founders. Step 1, sourcing. This is the art of finding the next big thing before anyone else does. VCs scour Twitter, attend demo days, read obscure blogs, listen to pre-launch podcasts. They follow 17-year-olds on product hunt like talent scouts at the NBA draft. Some founders get intros from other investors. Some go viral on TikTok and suddenly get 15 calendar invites titled Quick Intro. Once a startup gets on the radar, it's time for step 2, screening. You skim the deck. You check for buzzwords like AI, community, or decentralized. You ignore the grammar mistakes and try to guess if the founder's delusion is visionary or dangerous. The goal here? Figure out if this is worth even opening a Notion doc for. If it passes the vibe check, you move to step 3, due diligence. This is where the real work begins. You dig into the product, the team, the market. You model out the potential returns, run scenarios, stalk competitors, call ex-employees, maybe even try the product yourself if it has a login that works. You ask hard questions. The founder gives soft answers. You pretend to be fine with that. Then comes the investment committee. This is your internal Thunderdome. You pitch the deal to your partners, you debate, you defend, you throw stats, market maps, anecdotes, and the classic line, if we don't invest, Sequoia will. If you win the room, term sheet sent, but the job doesn't end there. Post-investment, you become part therapist, part coach, part recruiter, and part PR manager. You help with hiring, you join board meetings, you advise on go-to-market, you make intros to other investors. Want to break into VC? There's no set formula, but here are the usual suspects. First, the ex-bankers. Fresh out of Goldman or Morgan, they bring spreadsheets, valuation skills, and a borderline unhealthy attachment to EBITDA. Second, the ex-consultants. Ex-McKinsey, ex-BCG, they build beautiful slides, say synergies with a straight face, and can size any market in under 20 minutes. Third, the ex-founders. Battle-scarred, resilient, allergic to BS. They've built before. They know the pain. They bring intuition that no model can replicate. And then the wild cards. Maybe you built a following online. Maybe you angel invested in a startup that blew up. Maybe you joined an accelerator or interned at a fund. Maybe you're the rare Gen Z who reads SEC filings for fun. Whatever it is, you need edge. Because VCs hire in tiny batches, and everyone applying has the same credentials. Now let's talk culture. VC culture is weird. It's startup energy with a finance budget. You'll work from Bali for a week, call it a global founder immersion, and still expense the cold brew. You'll have 5 Zooms in a day and somehow still feel productive even if nothing happened. It's a world where optimism is currency, skepticism is discouraged, and LinkedIn humble brags are an Olympic sport. The hierarchy is flat until it's not. Everyone's on the same level until carry gets discussed. You'll spend more time networking than working. You'll go to pitch events, dinners, retreats, panels, Slack communities, and Discord servers. You'll join group chats with names like Operators Anonymous and VCs Who Lift, and somewhere along the way, you'll start believing that adding value means sending one email. Why is VC heaven for finance bros? Because you get paid to be curious, to meet ambitious people, to chase upside, to take bets. You're not pushing paper, you're backing potential. You're not managing risk, you're amplifying it. You're not just investing in companies, you're investing in stories, narratives, momentum. VC gives you access to founders, deals, markets, capital, to the front row of innovation, to the rare opportunity to shape what comes next. And yes, the upside is insane. Your first big exit could mean a second home in Lisbon, a podcast studio in your basement, and a guest lecture at a business school you got rejected from. But it's not all hype. You'll see great companies fail. You'll see mediocre ones raise. You'll miss unicorns. You'll doubt yourself. And sometimes you'll lose millions. But when you win, when you back the right team at the right time in the right market, that's when you remember why you joined this game. Finance doesn't have to be boring. And VC is living proof that chaos, caffeine, and conviction can print money. Follow at It's Money Decoded or pitch me your startup. I promise to ignore it respectfully. Catch you in the next one.